Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hey Lauren.
Hey everybody.
Hey Lauren, last week we talked about an important episode about sure tax deductions that are going to be expiring on December 31, 2011. Now, I thought we would use this episode to talk about giving people a little bit more warning about 2012 because
the tax code keeps changing.
Yes. And at the end of 2012, it gets really serious about the changes that could be happening that are set to expire.
Okay.
And the takeaway from this is that, tax planning, if we're going to be relying on, next year's Congress and whoever next year's president is to either extend the law or to come up with a new tax law, that's rolling the dice a little bit.
Yeah,
versus if we know for sure they're likely going to be expiring, perhaps you could take some positive steps to make the best out of the situation. So, so for instance, these are some of the major tax provisions that are set to expire at the end of 2012. First of all, the marriage penalty comes back into play. So what that means is that there's been a temporary reduction in tax brackets for people that are married filing jointly and they are both working. In the past, there's been a tax penalty, but they reduced that penalty. So the point is,
coming back.
Yeah, there's not much you can do about that if they're going to continue on working.
You could stop working, but we don't advise that.
But let's say one of the spouses may be in business for themselves and they have the ability to accelerate income into 2012 or bring it into this year. That might make sense to do that versus 2013. And then another big one is that the dividends are going to be. They're not going to be taxed at capital gain rates, long-term capital gain rates anymore. They're going to be back to ordinary income.
Right.
That's a big deal because right now they're capped at 15%. For some people that could go up to 35%.
Right.
And so my takeaway from that is it's a good idea to check up on your portfolio to make sure your portfolio that's not in a retirement account is as tax efficient as possible. And we believe one of the best ways to be tax efficient is to maybe consider using a passive index strategy.
Yes, exactly.
Now there's also there's the phase out of the child tax credit. So for people that have children that are now enjoying $1,000 per child tax credit, that's going to go down to $500 per child.
Okay. And are they phasing out completely eventually? Or?
That I'm not clear about, but I think I think it's going to be $500 for the foreseeable future. Okay. And then there's some lower tax brackets. There's a lower tax bracket for lower income earners, and that tax percent, the 10% bracket, that's going to be gone. And so it's going to basically be 15% is the lowest rate. And then the other one would be the lower capital gain tax rates. If most of your income is long-term capital gains, under current law, you could pay as little as 0%.
That's right.
On that. We've had clients
because you don't have other income.
Exactly.
Right.
Well, that's going to go away, and so it's going to be back to whatever your tax bracket is. That's what your capital gain rate is going to be. That rate. So the takeaway from that is if you do have capital gains, you're thinking about selling a business, maybe thinking about selling a property with huge appreciation, consider planning to sell it in 2012 versus 2013. Right. But that being said, if we're talking about big dollar amounts, please come to us and have us do some planning for you. Don't just make that decision based on a tax code change. Right. Do a couple more of these. The deduction for student loan interest ends. And that's a big deal with occupiers on Wall Street.
A lot of people are going to be unhappy about that one. I didn't take out student loans, and now I'm even more happy that I didn't take out student loans. Okay, and this is
a big one with the current economy. The income tax debt exemption for debt forgiveness on home foreclosures and repossessions goes away.
Really?
Yeah. So that's a big one because the people that are, especially for people that have lived in their home and they've taken home equity loans of credit, things like that, and their house value has definitely gone down. They could be taxed on that difference of that income. So, so we're going to end this episode, and we'll see you next time on Erickson TV. Thanks.
All right.